Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're very fortunate to have with us Marc Chandler. Marc is a managing director and the chief market strategist of Bannockburn Capital Markets. He's been covering global capital markets and currencies for over 30 years, including previously as the chief currency strategist for HSBC and Brown Brothers Harriman. Marc is also a published author of two books, Making Sense of the Dollar and Political Economy of Tomorrow, and regularly shares his views on his blog, Mark to Market. Welcome to the podcast, Marc.
It's a pleasure to be here with you today.
Marc, before we dig deeper into markets and currencies, can you share with us your current view of the macro environment, both in the U.S. and globally? What's your current take?
Yeah, so of course, it's a highly volatile situation. I think that we're in a new world. And this new world, I think, is, I'd say two elements to it. One is that for the past 125 years or so, the U.S. endorsed free trade, more or less codified in the World Bank, the IMF, and the GATT and WTO.
What about the Fed? Can you share with us how you're thinking about the Federal Reserve in 2026 and what do you see as potential impacts there?
Sure. So I think that the Federal Reserve is on hold in the first part of this year, like it was at the first part of last year. It cut rates three times, pauses, an extended pause. And I think that a combination of the corporate tax cuts, the tax refunds to American households, we'll see a relatively firm Q1. And also, we get the payback for the government shutdown late last year. So I think the U.S. economy does well enough that the Federal Reserve can then shift its focus for the first several months of this year from the labor market to inflation again. And so I think this puts the Federal Reserve on hold, but I'm in a camp that thinks that the U.S. economy is slowing, the labor market is slowing, and that this will lead the Federal Reserve to cut rates more, probably starting in Q2. I'm looking at 2 to 3 cuts this year. The Federal Reserve's latest summary of economic projections points to the median points to one cut, but you know how it is. The median is is more concealing. It's sort of like the story I tell sometimes about the guy whose head is in the freezer and his feet are in the oven and his average temperature is okay. And that's really what the median is like, the median dot for the Federal Reserve. It really hides. We have a Federal Reserve official who's talking about more than 100 basis point cuts this year. And we have other Fed officials thinking that maybe 1 or 2 hikes might be necessary. So we have a wide dispersion of opinions at the Federal Reserve. And the big deal this year is going to be, of course, perhaps even later this month, that President Trump nominates a replacement as the head of the Federal Reserve from succeeding Chair Powell. The interesting twist to this that many people might not fully realize is that while Powell's term as chair ends in May, his term as governor extends into 2028. And it's possible, it's not completely unprecedented, but it's uncommon for the chair to stay on. That is for Powell in his what I think is a very deeply held conviction about the independence of the Federal Reserve, that to avoid politicalization of the Federal Reserve, he may stay on as governor even after his term as chair ends in May.
So as part of the investor mosaic, we've got the Fed in flux, geopolitical a little bit, sounds like in flux, right? You've still got Russia, Ukraine, China, now Venezuela. How should investors factor this into their sort of viewpoint or their own mosaic for both equity and currencies?
Yeah, I think that this uncertainty probably means higher volatility. But when we think about volatility, something like say the stock market is called the VIX for the S&P 500. Typically, the VIX rises. That is, volatility, measured volatility, rises in a bearish market. That is when the stock market sells off. And I think many people are concerned about the overvaluation of the stock market, especially how concentrated it is. I think the same thing is true in the dollar. When the dollar sells off hard, like we saw in the first half of last year, volatility rose. And volatility in the markets, volatility is really risk. It's how much things can move. And I think that higher risk means that we should make our position smaller, especially if we're using leverage, and just be aware that prices that we see, it's sort of like, remember what happened to those rare earths, many of those companies last September, last fall, we had huge rallies. And I think we need to be able to take advantage of those and take profits just as much as, and think about that, taking profits, taking money off the table as much as we think about putting money to work for us. So I think that creates opportunities, but volatility is risk. And I think in this geopolitics, uncertainty about the Fed and other central banks for that matter, we should be thinking about the higher volatility, higher risk environment we're entering.
Specific to foreign currencies, you've talked about volatility just now. If he had the opportunity to construct a long-short portfolio of currencies, what would that look like in 2026? How would you comprise that?
It's interesting because I think that's a good way to think about it is as a portfolio. And there are some people who just trade currencies, but currencies are also very important. Foreign exchange fluctuations is also important in the other asset classes. If you have a basket of international equities, the currency swings could be a third of your total return. And if you have a basket of international bonds, the currency component could be two-thirds of your total return. But if you're thinking about just a portfolio of currencies, oftentimes the sort of the go-to answer is buying the high yielders and selling the low yielders, a type of carry trade. However, I think that in this coming year, we're going to see is this bifurcation. Countries like the United States, the UK, possibly Norway, likely to have to cut interest rates again. On the other hand, Japan is likely to be raising interest rates. And other countries like the Eurozone, uh, Canada, Australia, they're likely to be on hold. Possibility of Australia raising rates. So I would be doing the opposite. I'd be buying those countries that are done with their easing cycle and selling the currencies where the central banks still have more room to go to ease. I find that this is that oftentimes in the foreign exchange markets, the dollar is still the king. And the dollar, I think, is heavily influenced by U.S. interest rate developments, more so than what theory would suggest, which would be focusing on interest rate differentials.
What about also, there's some aspects as you speak to clients, you think, and given your long tenure in the space of the FX markets that are sort of still misunderstood or underappreciated by investors?
Yeah, I think that oftentimes what happens is, and when I read like the Wall Street Journal or the Financial Times and their currency coverage, and I look at analysts' report, it often seems like their main clients or their main readers are hedge funds, people who have discretion, who want to take risk. But at Bannockburn, our client base are corporates for the most part. They're not looking to take on new risk. I could have the best trading idea in the world, and it won't mean anything to a corporate treasurer. The corporate treasurer's job is to minimize risk. They work hard to produce a competitive product or a service, and they need to manage the currencies as a risk. And so I think that in the back of our minds, we have this idea that the markets work where buyers and sellers come together, profit maximizing actors, and out of that emerges a price. And I think that the game is much more complicated. They do have some risk takers, but you also have people who want to unload that risk. So I'm often encouraging our clients to manage the risk, that there's some risk that can be managed. Maybe what happens, like you're saying in Venezuela, might not be able to be managed. But what happens to the foreign exchange market or interest rates or commodities can be managed. And it's not just for big businesses, but even small businesses have access to the same kind of hedging tools that large businesses do. And so I think it's partly to know where you are. Are you taking risk? Or are you on the corporate treasurer side or hedging? And it represents a different, it just complicates the game of that my clients are not necessarily trying to maximize their profits. They're trying to unload the risk. They send out an invoice and they want to lock in that price. So I think probably the biggest thing that's misunderstood about the foreign exchange market is the how complicated the players are themselves. Even though, of course, currency can go up or down like any other asset. But I think what really complicates it is just how wide of a dispersion of types of actors there are in the foreign exchange market. Some only are acting, just transacting. For example, when I was at a custodian bank and a client would come in, typically a mutual fund, and buy sterling. They were not telling us anything about where they thought sterling was going. What they were telling us was that they were buying a British asset. If George Soros or a hedge fund came in and wanted to buy sterling, we were getting a signal. They thought sterling would go up. So I think it's really trying to keep the noise and the signal clear.
And are you seeing any change in sort of sentiment within that client base, say from 2 years ago, and particularly given the potential for volatility you've described as the backdrop?
Yeah, well, I think what's happened is that when the dollar was in an uptrend, and the dollar, that's one of the things I love about the foreign exchange market. A person like me, we don't need a lot of ideas. Trends in the foreign exchange market last 5 to 10 years, more or less. The U.S. dollar has been in an uptrend basically since towards the end of the great financial crisis, and it may have ended. And when the dollar's in an uptrend, our counterparties, so the people who were buying, say, a German machine tool from, they're happy to take dollars because the dollar is an appreciating asset. But since September of 2022, the dollar index, the basket that the dollar trades against, has actually been falling. It peaked in September 2022, and that big sharp drop we saw in the first part of last year prompted a lot of our trading partners to request to be paid, especially by small and medium-sized companies in other currencies besides the dollar. They didn't want to take what they thought was a depreciating asset. So I think the biggest change that has taken place in the last period has been this shift from a rising dollar environment to a dollar environment people are more skeptical about, and therefore less desirous to take dollars as payments.
Anything in particular also that sort of separates those companies that manage FX risk well versus those that may be caught sort of flat-footed at times?
Well, I think that large businesses typically have tons of MBAs and market savvy people helping them. I think it's really the small and medium sized businesses that might not have that same skill set. And that's why being trusted advisors becomes more important to small and medium-sized businesses. But I think that there's been a democratization of the capital markets in my career. When I first began, one needed about $1 million to make a foreign exchange transaction in the spot market. And now small businesses can transact for really relatively small amounts of money. And maybe this is another point to think about is that what is the price of the say currency? So looking at say the euro, we trade it in four places on the other side of the decimal point. So right now it's at about say 1.1650. For the large players in the market, there's actually another digit on the other side of the decimal point. So rather than trading a tenth or hundredths of a penny, the large pools of capital see a bid and offer spread of maybe a thousandth of a penny. While small and medium-sized businesses are treated more like tourists. Sometimes when we see a prospect and we ask to see their recent pricing execution, sometimes we see that they're paying 3 to 4%. And so the takeaway, I think, is that just like when we buy a suit or a pair of shoes, or we know that we're paying a retail price, and we know that there's a wholesale price for it as well. And I think the same thing is true with money, whether it's currencies or interest rates. For example, the wholesale price of money might be the Fed funds rate, but the retail price of money is like 21% or 22%, whatever my credit card is trying to charge me. And so it's just to be aware that there's a retail and wholesale price of money. And you know what they say about poker? If you don't know who the mark is at the table, it's you. And if you don't know the difference between wholesale and retail price of money, it means you're probably paying the retail price.
And shifting to alternative assets, which is obviously in the news a lot, had a good year last year. Let's start with gold. Where does that fit in, do you think, to sort of a general portfolio manager portfolio? And is gold better understood today as an inflation hedge, a geopolitical hedge, or a currency hedge?
That's an interesting question. My career began with a floating exchange rate regime, but there's always been this special uh, role for gold. Gold has been held by central banks as reserves, and I think that's one of the notable developments behind gold's rally has been the use by central banks moving a little bit, I'd say, a discretionary basis, try to diversify away from dollars. And some central banks like China obviously have been buying gold. But even it's not just sort of rivals or adversaries of the U.S. buying gold, but many central banks that are close to the U.S. For example, like Poland, a great NATO member, it looks like they probably bought more gold in the first 3 quarters of last year than China did. So I think that the first cut, I think, is that gold. The first thing to keep in mind, central banks are buying gold and they're holding it off the market. That is, they're not that price sensitive, and they're not trading it. They're buying it and holding it. Secondly, because of the rise of gold ETFs, exchange traded funds, it makes gold, paper gold, say, more accessible for small investors. Also, we saw, I think Costco began selling gold and I think silver. And that makes it, and when they're selling this, they're not selling ETFs, they're selling the actual bullion like gold coins. And I think this also makes it more accessible to investors. I don't really see gold as being a great hedge for inflation. It can go through some great run-ups like it is now, but it doesn't seem to be so much about inflation. And remember what happens, gold is one of these assets that don't generate a yield. So in a rising interest rate environment like we've had, it becomes more expensive at opportunity cost of holding gold. But I think that the other thing I'd say about gold is I think it's partly misunderstood. I know a lot of people think gold is only like a precious metal or for jewelry, but if you take a look, uh, a ton of cell phones has more gold in it than a ton of gold ore. And partly that speaks to how little gold there is in gold ore, how much it has to be refined. But I think it also speaks to the industrial use of these so-called precious metals, like silver, which has really rallied up like 3 times what gold did last year. And part of it is from its industrial use. Both China and the United States now regard silver as a critical or strategic metal.
And shifting to cryptocurrency, where does that fit in your mind? Sort of currency, commodity, technology, speculative asset?
Yeah, so crypto, I think there's nothing really about crypto that makes it money except that they call it crypto money or cryptocurrencies. Even Bloomberg, you have to have you have to identify the kind of asset it is, and even Bloomberg considers crypto like Bitcoin or Ethereum as a currency. But I think if I put my economist hat on, I don't think it really meets the definition of what economists call money. It's not really a store of value. It's too volatile. It hasn't been proven yet. It's not really a means of transaction. But of course, we've all heard about the guy who bought pizzas with Bitcoin early on. And I don't think that it's there's not a means of it's not a store of value, and it's not an accounting unit. You're not going to see prices quoting Bitcoin really. I sort of would think about Bitcoin. This is how I would conceptualize it. Clearly it's an asset. People have obviously bought it. But I sort of think of that crypto is the savings, what trees are to carbon. Trees take carbon out of the air and they put it someplace more useful, making wood, less dangerous place. And I think that if this money wasn't chasing crypto, where would it be? It'd be chasing house prices more out of reach of common Americans. It'd be chasing stock market prices, be even stretching these currently stretched valuations. So I sort of think about crypto as a bit of a savings sink that puts the savings that could be doing something more dangerous, running up real asset prices, and it sort of warehouses them in this thing that it's that you don't really see, that you can't touch, that doesn't have an interest rate yield associated with it. So I think it's an incredibly new asset, and it is a sink for savings. People might find utility in them in terms of personal like or dislike and that kind of thing, but ultimately no real economic value.
Is it fair to say you don't see sort of a pathway to this becoming sort of a genuine monetary alternative, or is still some pathway for that?
No, I think that that just like the governments, say the state, has a legitimate monopoly on justice, on the use of force. I think it also is a state monopoly of the power of coinage. And so I don't think that a country is going to really embrace, I mean, a major country. Of course, we've seen some, it's usually those countries that are the most desperate have played around with crypto. And the same thing is true, I think, for corporations. But what would the corporate treasurer do if he was paid Bitcoin? They'd have to sell it right away as they manage the risk. They have neither revenues nor expenditures in crypto or Bitcoin in particular. And so what would it do for them? Nothing except put a risk on the balance sheet. So I don't think there's really a pathway for crypto to replace the dollar or to be really a significant part of world currency reserves that central banks own. I would say there's a smell test for it. And this is the smell test. I buy into the stories that the origin of money really has to do with taxes. And if the IRS were to say, we'll take Bitcoin as payment for taxes, I'd be more willing to admit I'm wrong and that crypto does have a legitimate place. There was a case, I think a city or a village in Switzerland was accepting small amounts of Bitcoin towards the tax payments. But this was sort of one of those like odd stories, idiosyncratic and not really generalizable.
And you just briefly touched on the dollar. How should investors think about the dollar and its role as the world's reserve currency? Is that intact? And what is your outlook for the dollar?
Sure. So the dollar is still the most used reserve asset. And it's not, when we think about what the central banks have in their reserves, they just don't put dollars. They put U.S. Treasury bonds or agency bonds like Fannie Mae, Freddie Mac into their reserve. Most of them don't just hold cash dollars like you or I might have some dollars sitting sitting in our couch or sitting in our wallets right now. So the central banks, I think, still use the dollar is still the number one reserve asset, but it has fallen partly as MBAs and CFAs, charter members, become active at the central banks and they bring better business, better money management practices to these institutions. And we know that diversification is really one of the best ways to manage risk. And so there has been some diversification, but I'd say that the second most important currency is not China. China is still a very small part of global currency reserves. The euro is the second biggest after the dollar. And then after you drop off from the dollar and the euro, which together are almost, say, call it 70% of world reserves, maybe even closer to 75%, it really drops off. Sterling, Canada, the yen, China. But I don't think that in the big picture that the dollar's role as a reserve currency, these central banks act at like glacial speeds. So it really moves the foreign exchange market tends to be the private sector. Not only people like us, tourists, investors, large corporations, hedge funds. These are the drivers. These flows are the drivers of the FX market. And I'm in the camp that thinks that the dollar has peaked and we've had like several cycles, several sustained long-term bull cycles in the dollar and bear markets. And I think that, for example, Ronald Reagan, actually began right before Reagan was in office, but in the late 70s through the mid 80s, we had a super dollar rally. And it took the central banks coordinated intervention at the Plaza Hotel in New York, where they met, to drive the dollar down. It goes through about another 10-year bear market, and then we get sort of the next dollar rally. People associate with Clinton, but it was really partly Clinton, but partly the tech bubble, and also Robert Rubin from Citibank coming over to the Treasury and really first time saying that a strong dollar was in U.S. interest. And I think the signal was not so much about the price of the dollar as a signal to our friends, to people who hold treasury bonds, that the U.S. would not seek a weaker dollar as a way to minimize our debt burden. But that too ran into central bank intervention in early 2000. Lawrence Summers was the Treasury Secretary, drove the dollar down. Intervention, driving the dollar down. And we go through another prolonged dollar bear market until the great financial crisis. And since then, the dollar's been in a bull market. And in my work, I think that big bull market is over. And it's a question of pacing of the dollar's decline. But I think that what we saw last year, the dollar's weakness, was a small down payment. It was in the first half of last year primarily. The dollar, say roughly speaking, this dollar index, this basket the dollar trades against, fell by, say, about 9 to 10% last year. And I'm thinking that we're going to have roughly the same magnitude of decline this year. But rather than last year concentrating in the first half, probably will be concentrated in the second half of this year.
Is shifting back to equity markets, you alluded to it a little bit earlier about the weighting in the market. Basically, it's going to be the S&P 500 of technology driven by artificial intelligence. Can you share your own thoughts on the artificial intelligence opportunity you see possibly for financial markets, how you might use it yourself, just its overall applicability?
Sure. So I have various LLMs, these large language uh, like the ones you're all familiar with, ChatGPT, Perplexity, Google has their own Gemini. I use them, but I think as an investment though, I really figured that my money at mutual funds have probably captured that AI type of investment. So when I'm trying to manage the part of my portfolio that I'm trying to manage myself, I avoid that, partly trying to just avoid the replication of what the and duplication of what mutual funds are doing. But I think that this year, though, I mean, two things that occur to me. One is that just like we've seen in almost everything that we produce, surplus, excess capacity. How many LLMs do I really need on my laptop, on my work computer? Won't one or two be sufficient? Do I really need four or five? And how will we make money? Just the same way the internet or airlines revolutionized society, but it's hard to make money directly from them. So one thing that bothers me or scares me is that there's a lot of building of these data centers, and I'm just not sure the return that they're going to get, especially all of them, that there'll have to be a shakeout at some point. Secondly, I think that industry is evolving so quickly. These machines are learning, and I think that for me, I'm trying to go downstream this year, thinking about not just these AIs that we have access to on our desktop or computers, but really embedding them. I'm really fascinated by what's going to be the next step, and I think it's really linking up the AI with robotics. And so I'm looking at other companies trying to see who will win in this AI like challenge or battle. And I think it's those who utilize it, embed it in other products. And so that's what I'm looking at more on the robotic side. But it does concern me that even the U.S. economy, people like myself had expected the U.S. economy much weaker than it was in 2025. And I think part of the reason the resilience of the U.S. economy is the AI. I was looking at a chart earlier today in the Financial Times. It suggested that most of the growth in the U.S. economy last year was due to the AI and the technology spending. Uh, and that I think just shows the concentration and below the surface. Then, if you exclude AI, the economy might be a bit weaker than the official data would suggest.
On a lot of topics, and I'm just wondering what do you think could be some of the potential surprises as you look toward 2026? Where do you think there could be macro policy developments or just other items which could be surprises, and how do you think that'll impact markets and how should people manage money in light of that?
Sure. So I think that a couple surprises could be in store for us. One is geopolitics. It seems very unsettled now. I think that, in some ways, it's, the markets we were debating last year when the dollar was selling off and U.S. stock market was underperforming, that we've lost U.S. exceptionalism. But I'd say in the last couple of weeks, what we've seen is a resurgence of American exceptionalism. What the U.S. did in Venezuela, I don't think that there's other countries that could do it. And I don't think that other countries could do it without, by escaping such broad criticism as the U.S. has done. So I think American exceptionalism is still being demonstrated there. And the other thing that happened to start this year is the U.S. corporations were given an exemption from the OECD's corporate tax reform that had a minimal tax for large corporations of 15%. And the U.S. exceptionalism, even though at the time President Biden and Treasury Secretary Yellen helped negotiate the treaty, under President Trump, we're exempt from the treaty. And I think that illustrates this American exceptionalism. But I think that when it comes to surprises, I think that outside the US, the Bank of England, maybe Norway Central Bank, the swaps market is pricing in that most other central banks are done with the easing cycle. The next move will be a hike. And I just wonder that if the US, the Federal Reserve eases like I think they will, two or three cuts this year, and the US economy weakens, will other central banks, like maybe Canada, will they have to cut rates again? Now, we've seen some very low inflation readings from the European Central Bank. Will they have to cut rates again? So I think that surprise could be that the market's pricing in the end of the easing cycle and maybe there's more room to go. So besides the geopolitics, I think that this possible shift in monetary policy, maybe the market's leaning a little bit ahead of its skis for completing the monetary cycles outside the U.S. And I think that, of course, there's this other risk that people have in the back of their minds, I think, about gold. And here's what happens. The gold is carried on the U.S. books at around $43 an ounce. And the U.S., has the most gold of any country in the world. There's talk that President Trump would revalue the price of gold and thereby boosting the assets of the U.S. government. And this, I think, could have far-reaching ramifications as well for precious metal traders, but also currency markets.
Lastly, for those who sort of want to dip their toe into FX, whether it's through an ETF or some other vehicle, what would be your advice to them as far as their decision making and what their approach should be?
And, I spent my career at foreign exchange and really see it as like a big picture glass window. All the things that affect equities and interest rates, commodities also affect currency markets, international movement of capital. But the currency markets, what you have to appreciate, I think, is that it's volatile. And the way, and the other thing that's sort of relatively unique to the currencies is margin. Is that most people who trade currencies do it on a leverage basis. When you buy a stock, the broker tells you how much you can have, how much you could borrow from them. You want to buy $100 worth of stock. The Federal Reserve sets the margin right now at 50%. So if you're buying $100 worth of stock, you have to put up $50. In effect, your margin money is good faith toward your future purchase. It's a down payment toward your future purchase. But that is not the way margin works in the capital markets. The margin that you put up in the capital markets, including in the futures market, is really a function of volatility. So recently, silver has become very volatile, and the exchange raised a margin requirement for trading silver. So that the margin in the equity market is a down payment toward your future purchase, but in the capital markets, it's a down payment toward your future loss. That is how much you could lose before me, your broker, can liquidate your asset. And so I think that the currency markets, unlike the equity market, it's great. The stock market is open from, say, 9:30 in New York till 4 o'clock in the afternoon. What happens overnight tends not to be necessarily a big deal, right after the earnings and that. But in the currency markets, even though many of my friends think that the sun rises and sets on America, it's just not true. When I get up in the morning, 4 or 5 o'clock in the morning, Asia is winding down and Europe is beginning their day. When I go to bed at night, Asia is beginning their session, or well into their session, I should say. And so in the currency markets, you have we in the U.S. have only a limited time compared to relative to the world's 24-hour trading day for currencies. So I think that the time it's traded is much larger than U.S. stocks. The margin is set differently. And I think it's one of these things, if you ever watch these poker games on TV, that the person with the big stack in front of them are an advantage to the person who's got a small stack. It works the same way, I think, in the currency markets. The large hedge funds, the large corporations, the large asset managers have an advantage over us smaller fish. And I think to go into that, I'd say is more like you're not playing blackjack in Las Vegas. You're playing poker, and the house, in this case, the counterparty, the large asset managers, the large pools of capital, have a clear and distinct advantage.
Mark, thank you for joining us today and sharing your perspective and valuable insights. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance.